Responding to the Wall Street Journal Sui, a USD trillion trade surplus versus monetary flows, which is real, which is fake. If China truly created a $1 trillion trade surplus in 2025, basic economic logic would imply rising foreign exchange reserves, expansion of the monetary base, ample banking liquidity, strong corporate financing demand, and an active real economy. Yet reality points in the opposite direction. China is facing its most severe monetary liquidity squeeze in 30 years, creating a fundamental contradiction between claimed surplus figures and actual monetary flows. So which is real, and which is fake? First, if a $1 trillion surplus were real, monetary liquidity would not be drying up so rapidly. Banks would not be reluctant to lend, households would not struggle to withdraw cash, and corporate investment would be booming. Instead, bank vaults are short of money. Second, a real surplus should expand the monetary base through foreign exchange inflows. But M2 growth is slowing to multi-year lows, corporate lending has collapsed, cash withdrawals are difficult, and capital markets are drying up, directly contradicting the surging surplus narrative. Third, widespread local government fiscal distress cannot coexist with a surplus miracle. From 2024 to 2025, around 30 provinces faced delayed wages, depleted healthcare funds, pay cuts for civil servants, and halted infrastructure projects. Fourth, why has the surplus failed to lift foreign exchange reserves? In theory, a $1 trillion surplus should have driven a sharp rise. In reality, reserves barely fluctuate, FX settlement keeps falling, capital outflow pressure intensifies, and the renminbi stays near its lower limits. The problem is not that Western media lack intelligence, but that they underestimate China's hidden system of accounting adjustments, inflated offshore trade, fictitious flows, and internal offsetting. In China, data and reality are often disconnected. In short, monetary flows expose the surplus as an illusion. If it were real, money would not be this tight, banks this stressed, public finances this strained, nor households under such severe financial pressure.